You're watching a man lose $340,000. 47 minutes, 2 monitors, 6 charts, a Bloomberg terminal, an algorithm trained on millions of market observations, a PhD from MIT, a team of researchers feeding him information in real time. And still he's losing. If the smartest people in finance have the fastest computers, why are so many of them still struggling to beat the market? Every major hedge fund has analysts. Every major hedge fund has data. Every major hedge fund has models. One fund hires physicists. Another hires mathematicians. Another spends millions collecting alternative data. But the moment everyone has access to an edge, it stops being act as an edge. And that's why investing became an arms race. Here's where the story becomes strange. The largest pools of wealth on earth are often with those with the least interested in predicting tomorrow. Instead, they focus on something else entirely. The time. They don't ask what happens next week. They ask what could happen 10 years from now. A trading strategy succeeds. People copy it, and the returns shrink as hundreds of traders rush in. Eventually, the advantage disappears. The market continuously attacks certainty. Yesterday's genius often becomes today's average performer. So, where do the real advantages hide? Where do durable advantages actually come from? The answer is often from places that don't look exciting. The ability to hold through uncertainty. The ability to think beyond the next quarter. So why do so many brilliant people keep playing this game? Because markets don't just reward skill, they reward activity. Every trade feels like progress, every prediction feels valuable, every new piece of information creates the illusion that you're getting closer. But information has a hidden cost. It demands action. When you know more, you feel compelled to do more. Buy, sell, adjust, react, repeat. Ironically, the investor who checks prices once a month may outperform the one checking them every minute, not because they're smarter, but because they're less tempted. The greatest enemy of long-term returns isn't ignorance, it's unnecessary action. And markets are exceptionally good at making action feel intelligent. If more information creates more temptation, and more activity creates more mistakes, then perhaps the real edge isn't finding better information. Perhaps it's knowing which information deserves to be ignored. History remembers the investors who made spectacular predictions. But history is built by the investors who quietly owned productive assets while everyone else argued about tomorrow. They rarely appear on television. They rarely make headlines because patience doesn't look dramatic until 20 years have passed. That's the strange thing about investing. The winning strategy often feels boring while you're living it. The trader didn't lose because he lacked information. He lost because he was competing in the most competitive arena in finance, where thousands of equally brilliant people were trying to exploit the same tiny inefficiencies at the same time. His opponent wasn't the market. It was everyone else like him.